Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today we have an episode that we don't do enough, and we should, but we're doing a listener questions episode. We get tons of questions on this show, and thank you for sending them in. We love your questions. We don't always answer them, but we try to answer the ones we think are pertinent and ones we think that everybody can benefit from. So don't be afraid to send in your questions. We love them. Also, we love your feedback. Love us or hate us, send it in. We always enjoy hearing it because we try to make this show better for all of you, and the only way we get better is by getting feedback. So thank you again, and please send that in. So today we have our panel of Doug Hagerin. Hey, Doug.
Great. How you doing, Kirk? Good to see you again. Long time no speak. And hey, we do love feedback. Negative feedback means you're listening. So any feedback, and usually I know that might be directed negatively at me, Kirk, but thanks for having me anyway.
That's okay. I try to hide Doug's negative feedback from him. So
my fragile ego can't handle it.
And also we have our very own Barb Freeberg. Hey, Barb.
Hi, guys. Happy to be here. Let's get going.
All right. Well, let's get started. So the first question comes in from Steve, which is, how can I diversify my investments to manage risk?
Okay, that's me. Diversification is like, don't put all your eggs in one basket, because if you have all your eggs in one basket and you drop the basket, you're in trouble. And what that means, according to investing, is different investments have different characteristics and typically do not rise and fall at the same time. That's called correlation. And all that means is you want some stocks and bonds. And let's forget about 2022, because that was a once in 100-year event. And hopefully, if your stock portfolio is going to fall, you might have some bonds there to shore it up. So if the stock market falls 30-40% and your bonds either hold even or they rise a little, you're not going to experience that 20 to 30-40% in your entire portfolio.
Great. All right. Thanks, Barb. Next one comes from John, which is, I always love learning from other people's mistakes. What are some common mistakes investors make when they're investing? Doug, you want to take this one?
Yeah, and I deal with a lot of retirement plans, and that's where I see a lot of these mistakes. I think one of the biggest mistakes that people get into is they get over emotional in terms of how they're going to invest. So they look at what the market's doing. They listen to other people. They figure out how they're doing. They talk a lot, and then they start to sit there and say, well, I'm not making enough money, or I'm losing too much. And on one regard, what happens is you start shifting. And going back to what Barb said, you start shifting too much and chasing the things that you're seeing might be doing better, trying to get more return. And again, and as I've said before, going back to Barb's thing on diversification, you're not diversified if you don't dislike something in your portfolio, right? Because there's things that are got to balance that out. And so people will over concentrate trying to chase the things that are doing well. The other side of it is when they don't do it well anymore, they will get emotionally invested, pull out, and all of a sudden, now you pull out the markets at the wrong time. That there's no real strategy going into the investing. Another thing, again, if you're in a retirement plan, a lot of companies are giving you free money. One of the biggest mistakes I see in terms of investing is people aren't taking advantage of that. And I see people that aren't contributing in the plan, or they don't contribute or invest at all because maybe the plan doesn't have a match of some kind. So, I mean, this is obviously something we could spend a lot of time on, but I think the biggest mistake that people have is, first of all, build a foundation. Keep yourself immune from the market. Second of all, don't get emotional. I'd say that's the number one mistake people make in investing. It's through emotion. You've got to separate that from and have a real plan on where you're going to invest and stay diversified, like Barb said.
Great. Cool. All right. The next question is from Julie, which is, what are the key differences between stocks and bonds, and how should stocks and bonds behave differently in different market conditions? So I'm going to take this one. So stocks, and it's really interesting because I think a lot of people over the last 20 20 years have forgotten about bonds, and rightfully so, because bonds have returned a very low rate of return. Now, the difference is basically, if you think about a company, let's say you're starting Acme Corp, which is, what the Wile E. Coyote uses to catch the Roadrunner, Acme, if you guys remember the Looney Tunes. So Acme is creating this widget, right? And if they want to grow, sometimes they need to borrow money to grow. And if they borrow money, they go to the bank and say, hey, I need some money. And the bank says, sure, we'll lend you some money. It's 5%, and we'll lend you $1 million. And then they use that to grow the company. Now, the bank takes that fixed income or bond, and then they sell it to the public markets. And then, we all buy that and sell that. Now, that is debt. That is a bond. And a bond is basically a contract to, if you buy a bond, you have a contract with the company that they're going to pay you 5% interest a year, and they're going to pay your principal back at the end of that bond. That is a bond. And a stock is basically equity in the company. And if you have equity in the company, it means you technically have ownership. You're an owner of the company. So if you buy Apple stock or Microsoft stock or GE stock, you're an owner in that company. Albeit you're probably a small owner because there's so many shares, but you're an owner nonetheless. Now, the difference is when you own a bond, you have credit risk or default risk. So it's possible the company could not pay you back the money. It's possible, right? They give you a percent interest, but at some point they come on hard times and they don't pay you. It means you lose your interest and you lose your principal. However, you have a claim on the assets of the company. So if the company goes for bankruptcy, you go to bankruptcy court, and the bond holders have a priority claim, which means that whatever assets, let's say they have a building, let's say they've got some like raw materials, some widgets left over, all of that goes into the court, and then they sell it all and they come up with a number, and the bondholders have a claim to those assets. Okay. Once those claims are paid off, everyone else after that can take subsequent claims, which are equity holders. So if we go for bankruptcy and all the assets are taken by the bondholders, there's nothing left for the equity holders. So the equity holders have a risk as well. If the company goes bankrupt, then you most likely will have nothing. However, with equity holders, you also have the potential for the upside. So any sort of dividends, any sort of growth, any sort of valuation, you get the benefit of that, which you don't get as a bondholder. So they tend to operate differently in different market conditions because in a bull market, as we've seen in the last 20 or so or 15 or so years, has been a bull market. When stocks go up, you make lots of money. When you have a market like last year, when stocks go down, you lose money, right? Last year was interesting because stocks and bonds lost money, which is very, very unusual. Typically, when market conditions are good for equities, bonds don't do as well. And when markets are not good for equities, bonds tend to do better. Historically, that is what typically happens. I don't want to get into too much detail because we won't have time for anything else, but that's effectively how they differ. So bonds tend to be inversely correlated to equities. Not all the time. Last year, they both did poorly, but generally speaking, when one goes up, the other goes down. When the other one goes down, the other one goes up. Typically, that's kind of how they perform. So we can get more into that later if you have a follow-up question, Julie. Let's see. Next one, Barb. How often should I review and adjust my portfolio based on performance?
That is a great question, because there is a standard school of thought that you should, first of all, start out, create your performance, and create what we call an asset allocation, which means you have decided in advance what percentage of your portfolio you want in stock type investments, which are riskier, have the higher potential for great returns, but also greater losses, and then what percentage you want in bonds. So if you're young, your 30s, and you've got a long time recoup, you're investing for retirement, you'll have a greater proportion invested in stocks than you will in bonds. If you're older, you have typically more bonds, less stocks, because you can't withstand and make the money back of the losses. So step one, you decide on your asset allocation. And step 2 is then you rebalance your portfolio, usually once a year, to get it back in that pre-decided asset allocation. And the reason for that is it will reduce the volatility or the ups and downs of your portfolio. And so performance is inherently built into that. So when we say rebalancing, let's say stocks gain 20% and bonds hold their own, they stay about the same. Well, then you're going to end up selling some stocks and buying more bonds to remain in your asset allocation mix. And what that does without you even having to think about it is you buy more of an asset when it is priced lower, you sell when it is priced higher. And so you will, in the end, be incorporating performance into your investment planning. But I warn you, do not look at your prices every day, every week, every month. Typically, rebalancing once a year is fine. And for long-term investing, you really do not have to get in there and look at your portfolio all the time.
Great. Thanks, Barb. And thanks, Samir, for sending in that question. All right. Next question for Doug. This comes from Denise. How do life events like marriage and having children or changing careers impact somebody's financial planning? I'm earlier in my career, and I'd like to get a sense of what I should expect.
That's a really good question, because what we're talking about here is planning for the certainty of uncertainty in life. And those are the things that, the big changes. Before I get into that, I want to say that, the last question I started to answer about mistakes, what Kirk and Barb just spoke about are great follow-ups to that. A lot of what we're talking about today are mistakes that people make with investing if they don't follow and have that plan. So I really think that what Barb and Kirk just added was really valuable. With regards to planning to different life events, so obviously it's very hard if you are young to prepare to plan to get married, right? A lot of things can go on. It's very hard to plan to have kids because a lot of things that, can change there. And, and all of this is very much out of our control. So generally speaking, when we're starting to look at those life events, if those life events are occurring, okay, and they're already in place, this is a great time to go back and revisit the goals that you have. And the biggest thing that you need to start doing at that point is communication, because again, you are bringing in many cases, especially if you're already adults and you didn't just come out of high school and marry, and and now you're getting married and having kids later, you've already probably have your own vision of what your plans are. You've probably already begun to do some stuff if you've gotten smart and not made the mistake of waiting. And so has someone else, this person that you're going to be, joining with. So you got to get together and you've got to start to talk and communicate and begin to understand what it is that your goals are together. Okay. And with that, there's going to be some changes. I mean, first of all, you're going to have maybe twice as much income, maybe not. Maybe one person's going to work. Maybe both are going to work. How is it going to affect the income you have in the household? How is it going to affect the expenses you're going to have for the household? Obviously, if you're going to have children, you need to start thinking early on about what kind of plans you might have for college, someday, if that's something that's important to you. You also have to begin to plan as you start to put this life together about, again, not only the positive things that you need to begin to build for and how that's going to change and affect your investment and saving strategies, but it's also a really critical time to begin to protect and build that foundation of what if things go wrong. I see too many times, and again, go back to mistakes, Band-Aids that people put. They've got these plans and they're all, I forget what the old saying is, but the plan is only as good as it is before it fails, right? And so in this regard, I mean, things like, pretending to protect the things that are most important to you. What if someone passed away? What if a parent passed away, or your spouse or a child? How do you protect this? It's a great time to go back and revisit insurance planning for your household, so that if you have a catastrophic loss of income or a catastrophic expense situation in healthcare, you're going to be able to take those plans you've built and continue down the path. This is a very big topic we could go in a lot of different directions on, but I think that the first part is communication, and the second part is understanding the difference of building those blueprints around your life, building that foundation, and beginning to really understand what's going to change in terms of income, expenses, and protecting those goals that you are putting together.
Awesome. Thanks, Doug. All right. Let's see. What's next? I'm going to take the next one here. Okay. Should I consider investing in real estate and other alternative investments in my portfolio? I'm going to take this one. And this one's from Peter. So, Peter, it's a great question. And I think, I come across this a lot because we deal with a lot of alternatives in our practice. We're well known for putting alternatives inside of retirement accounts, which is something that most people don't know how to do. So we have a lot of fun with it because we see a lot of interesting investments. What I would say is this. There's two answers, one for alternative investments and one for alternative investments in retirement accounts. So if you're looking at alternatives, the question you should ask yourself is why? Why are you looking for alternatives? Are you looking for alternatives because you're afraid of the stock market? Are you looking for alternatives because you're running away from something or you're running towards something? Now, we get a lot of people call in. They're like, hey, I'm an expert in real estate. I want to invest in real estate in my retirement account. Great. I love those calls because if you're an expert in something, you should do more of that. If you're in healthcare, do more, invest more in that sector. If you're in real estate, do more of that. There's an added advantage of investing in the areas that you have an edge in. Now, I don't have an edge in real estate other than the conversations I have with my real estate investor clients. I don't invest in real estate. I mean, I do, but not like I'm not a landlord and I'm not running around, fixing toilets. That's not my business. But I know people who do. So if I have questions, I can talk to them. But that's not me, right? That's not what I do personally. Now, we do a lot with investors in portfolios, but if somebody doesn't have real estate and they're thinking I should invest in real estate, I'd say, well, why? Why real estate, right? It's not positive or negative. It's not like it's a good or bad thing. It's just, why do you want it? Are you running away from something? You're running towards something. If you're running towards something, it should be, hey, there's a great deal in real estate and I want to take advantage of it. Okay, that's awesome. If it's because I don't want to invest in the stock market, I'd rather invest in real estate, I'd say, okay, well, let's look at your premise. Why real estate? Why not horses? Why not private companies? Why not venture capital? Like, a bunch of questions you have to ask yourself. Because if you're looking at real estate right now, I'd say it's grossly overvalued in many, many areas. And I'd say, well, why? Because it's not any better of a deal than the stock market. The stock market's overvalued, real estate's overvalued, private companies, PE's overvalued. Global assets across the board are overvalued, in my opinion. And we'll get to Barb's next question about PE. But if you're looking at valuations, right, everything's expensive. So if you're running away from something, run towards something that's cheap, right? Like, some farmland is relatively cheap. You just can't find much. Like, we had a guy on a month ago, and he was talking about his farmland. And I talked to him after that, and I said, "Yeah, what do you got going on?" He's like, "Nothing." I was like, "I don't have any deals. Like, I can't find anything." It's like, okay, so it's rightly valued, but you can't find it. So it's kind of like real estate right now. Real estate's overvalued, but people aren't selling, which is why it's overvalued, because you can't find a real market. So I guess I would point out that it's a good idea to do from some perspectives, but just understand why you're doing it. Okay. Now, let's say you decide it's a good idea. Okay. Should I invest in alternatives like real estate or other things? Absolutely. There's some great advantages to doing that. And the advantage is diversification. And what I think a lot of people don't understand is why you diversify. Diversification, most people, they just say, oh, I got a bunch of mutual funds or stocks, I'm diversified. That's valuable in itself, but more importantly, how are you diversifying? You have to diversify within certain parameters. Because if you're just buying, you're diversifying because you're buying the big 5 tech stocks, Google, Meta, Microsoft, Apple, and Amazon. If that's your diversification, you're not diversified. right? You're just basically buying big tech. You buy one, you buy them all. It's not really, it's some diversification, but it's not really diversification. Diversification is finding low to no correlation or even inversely correlated assets to bunch together in your portfolio. And the idea is that, if the stock market's going up, right, and some things are going to go up more, some things will go up less. But if you average them out, it's going up to a certain degree. Now, if you diversify, you're reducing the returns of the best performers, and you're increasing the returns of the worst performers, and you're getting an average, right? So let's just say last year, for example. Now, typically stocks and bonds are inversely correlated to some degree. Last year, they were very closely correlated. Whether you're in stocks or bonds, you lost money. Virtually the only thing that didn't lose money was cash and gold, I think. I have to go look at the metrics, but everything pretty much lost money. So how could you have prevented your losing more money? Well, you could have had more cash, you could have had more gold, or there could have been other assets that did well. Last year, I think residential real estate went up 10%. If you had diversified into that, you would have done better, right? You could have owned, I don't know what did well offhand, but let's say farmland, for example. Let's say that went up. You could own some farmland, or you could have owned a private company, you could own this or that. But the more diversification you get, the more uncorrelated returns you're going to get. So you want to find a way to get ideally a static return where you're getting a smoothing out of the volatility of the portfolio. And that's a lot of what diversification does, is reduces your volatility risk. It doesn't reduce your portfolio risk as much on a macro level. On a stock by stock level, it does. But let's say you're owning indexes, so you don't have individual stock risk. You're really reducing your volatility, not your risk. Your risk is a permanent impairment of capital. Volatility is the bouncing around of prices, right? It gets to, like, if you look at 2020, that should have been risk, where the whole world economy shuts down. That should have been risk. It wasn't. It was volatility. It was just bigger volatility. The stock market dropped 20 to 30%, then went up, ended up the year, whatever, 7%. So just understand the nature of why you're doing it. Understand, is this going to help the diversification of my portfolio? And do I have an advantage of owning this? Is there some reason that if I own this over other things, I'm going to be in an advantage? So, hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. Let's move on to the next question. This one is, okay. Here we go, Barb. So is the market overvalued or undervalued? And should I even care?
Valuation means, are you paying a fair price? Are you paying too much? Are you paying a bargain price? And the way this is typically measured with stocks is something called the price to earnings ratio. And that's a ratio of the current price divided by the last year's earnings. And there's a lot of different variations on that ratio, but that's the premise. And what that means is if you've got a stock that's price PE ratio is 20, you're paying $20 for $1 of earnings. So how you use this data is that you can go and look at the overall PE ratio for the entire S&P 500. You can do that, look it up online for PE ratio for the S&P 500. You can get that. You can compare that number with the historical averages. And that's what it means when people say, oh, the market is overvalued. For example, current PE ratio now is about 25. The average is about 16. So we'd say, okay, we're paying $25 for $1 of earnings of the S&P 500 in aggregate. And under normal circumstances, it's $16. So you might say, holy smokes, that is way too much money. I'm going to get out of stocks because it's overvalued. It's good information to know. Does it mean you need to do anything? Not necessarily. And the reason is that the stock can stay overvalued for very long periods of time, and you can miss out on a lot of appreciation. So, do you act on the valuation? Well, if you're a long-term investor, you want to put money into the markets on a regular basis. And say if you put $100 in the market every week, when the market is overvalued, you're going to buy less shares with that $100 than you are when the market is undervalued. Long term, it doesn't really matter, but it's also good to know if you're going to deploy a big chunk of cash in the markets and you're investing for, say, 5-10 years, a shorter period of time. You may want to look at valuation and go, well, I don't want to put a big chunk of cash in a market that's valued at 25-30 PE ratio when the average is 15 if I'm going to need to pull that out within 5 to 10 years, because you're likely going to lose money.
Awesome, Barb. Thank you for that. And one more for Doug and one more for me, and we'll wrap it up this week. We got tons of questions. Once again, thank you for sending in your questions. And that last question was from Tony. The next question is from Sharon, which is student loans and education costs can be really overwhelming. I'm feeling overwhelmed every single day. What advice do you have for managing student loan debt and saving for education?
That's an incredible question. And of course, especially if you're a Gen X, like myself, it is probably on the back of the mind of almost everybody in this country right now, with anybody that has got kids within the, going to school within the next 4 years. The biggest thing that you can do, I mean, first of all, if you're feeling overwhelmed and stressed about this, the biggest thing you can do is get help. Okay. I mean, I'm just going to say, it's like anything in life. If you have someone to bounce those ideas off, get information, to weed through the just mass information, there's something like 20 million results that'll come back on a Google search on college. Okay. It's very difficult to weed through that. You get a lot of conflicting advice. Everybody's got a different opinion on this. But the second piece, again, going on your own, 85% of families go to the same 50 schools in this country. Okay. Picking schools based on name brand has driven people to paying more money than they should for college. Okay. The first thing you need to understand is you really need to take a look at what your affordability is. And again, like I've said before, disconnect the emotion from the logic. There's two components of this. At the end of the day, you got to have an emotional response. That's what the campus tours are for. But before you go there, understand and break down the college search into three critical categories. And these three critical categories must all be checked. Academic. Is it a good fit? Is it going to prepare your style? That's not a major. A major is branding and marketing. These schools are very good at building a game that sucks you in. The second, it is really understanding behind the scenes what schools do a great job of taking graduates in that field and walking them off stage on Friday into either grad school or career on Monday. And if they can do that, that school does a good job in that field. Okay. The second piece is financially. Okay. The financial component is what is going to be affordable to you and what is the true cost. People get swayed away by the posted cost that's out there, and that makes it even more overwhelming, right? When you start seeing 30, 50, $70,000 schools, that's actually not real. That is a price that they throw out there before they begin to apply discounts. You have to know the research. You have to have information about what the true net cost is, and that's going to be what you're really going to pay after discounts. And here's a real important thing to know. If you get outside those 50 schools, which of course have so much demand, ask yourselves, has a place ever given coupons if they have so many people going through the door paying full price? Absolutely not. Okay. So if you get outside the 50, how do those other 2,800, 900 schools compete? They compete by being able to match the brand names by giving discounts. So the average discount out there is actually at private schools are actually about 56%. And almost everybody, over half of people are getting some sort of a discount, even at public schools. So if you know what you're looking for there and you think outside the box, you're going to find schools that are going to be the right fit for your child and give you those discounts. And lastly, it's social. Social is, think of the top 5 things that matter to your family that are critical. Have that conversation. And then from there, make sure that the schools you're looking at are providing it. If you go logically at the schools that are going to fit academically and socially, and again, that's where you get emotional, because after you've logically matched all this, then you go to the campus and you'll be like, you know what? I thought this was a great school, but yeah, I just don't feel right here. Great. Now it's off the list. But don't go to a school and get emotionally attached and then try to convince an 18-year-old not to go there because you can't afford it. It's not, we all know what that's like to have those conversations with our kids. It's almost impossible, right? So if you line up and only look at the schools that have checked those boxes, you're going to put yourself in a much better position to control the financial aspect of it and be able to whittle that list down of thousands of schools down to maybe 6 or 10 that really fit you. So this is a much bigger topic again, but there's a few key points within there that I think can really help to reduce the overwhelming, reduce the stress, and reduce the financial impact of college.
Great. Thanks for that answer, Doug. And then the last question I'm going to take, which is, I'm worried about the volatility of the markets. How should I assess my risk tolerance? This is a great question. I love this question because, I think a lot of people don't fully understand risk tolerance, right? And I mentioned this in one of my prior answers, which is volatility versus risk. And I think what people need to understand is that risk tolerance is not static. It is variable. So if you think about it this way, in 1999, everyone thought they were an expert in stock market investing. And you had somebody like Jeremy Grantham, who's institutional investor. One of the more well-known ones where institutions actually buy his research and use their investing strategies. Very well-known firm, GMO. And, in 97, he said the stock market's too expensive. Take your money out of the stock market and put it into other things. And he ended up losing 40% of his assets from his firm because he was early. He was right, but he was early. And so at that time, everyone thought, hey, I've got a high risk tolerance. I can take anything, right? And what they really meant was, I want the best returns possible. It wasn't risk tolerance. It was performance management. They were saying, I want the best performance. But what they didn't stop to think about is that comes with risk. Now, if you followed for the subsequent years after the tech bubble burst, there are some tech stocks who haven't recovered yet. And it's 23, 24 years later. They haven't recovered. They haven't got to their all-time highs from prior to that. Now, some of them have, but not all of them. So my point is there is always risk in the markets, and we don't always identify with it because the markets go up 70% of the time. And when they go down, they typically fall off a cliff. And when they go up, they typically walk up the stairs, is kind of how it's seen. So people think that they're very tolerant of risk when the markets are good. The thing to ask yourself is when the markets are bad. Last year, the markets were bad. 2022, stocks were down, bonds were down. Virtually everybody lost money last year. And people are like, I don't understand. Why did I lose money? And virtually everybody lost money last year. And if you ask people last year what their risk tolerance was, you'd get a very different answer than you did in 2021. 2021, everyone thought they were aggressive and they wanted to be aggressive. And last year, if people lost money, they're like, I don't understand why I lost money. It's like, well, you're taking more risk. So the balance of risk reward is important. If you want to be more aggressive, you're effectively taking more risk. Now, that's not necessarily the case 100% of the time. And I argue this point with people, so I just want to make this clear. I'm giving you a general overview of how things work, which is if you take less risk, you will make a lower return. If you take more risk over time, you will get a better return over time, right? And this is, I'm going to be very clear. Year on, year out, not necessarily the case. But over like 100 years, if you invested in the riskier stuff, you would have generally performed the best. However, the volatility would have been crazy, too crazy for some people. Let's take like cryptocurrency, take Bitcoin. Bitcoin volatility is crazy. I mean, in 2017, I think it was, you could have made 1,400% returns and you could have lost 70, 80%. Well, that's more than most people can take. That is an asset class in of itself. That is the extreme of the extreme asset classes. But you have to understand, if you can withstand a 70, 80% drawdown of the assets, then you have a tolerance for that. But if you can't take that, then you should be mindful of how you're managing your risk. So the tolerance of risk is understanding the risk, which I think most people don't understand. They just assume I'm going to make money, and if it goes down, it'll come back. That's not always the case. It doesn't always come back. I mean, look at a lot of NASDAQ stocks this year. I mean, the big ones have come back, but not all of them have. A lot of good stocks are still flatlined from last year. So being tolerant of risk is understanding the risk you're taking and saying, if this goes down, I'm okay with that. I'm going to be able to sleep at night if this scenario happens. If you can't sleep at night because of a specific scenario happening, then you don't have the tolerance for that risk. And it's really hard to make this distinction when times are good, because you feel like, yeah, I could do that because you're feeling good. But if you're feeling bad, all of a sudden your risk tolerance shrinks a lot and it goes a lot lower and you're like, I can't be that aggressive. So the best time to assess your risk tolerance is actually in bad times, because it's how you're acting. So the tolerance for risk is how you act in bad times. So the best time to assess it is in bad times. But when people normally measure it, it's when times are normal. So just understand that about risk tolerance, that no matter what you're thinking, unless you've been through the bumps, the peaks and the valleys, and you can seriously withstand it and not look at things and be okay. If you can do that, great. But if you're looking at your portfolio and like, I can't believe this happened, like I'm never going to do this again, then you don't have the risk tolerance for doing that. And you need to be honest with yourself, because most people aren't. Most people are not willing to sit up there and saying, I'm wrong. I need to reassess what I'm doing. So great question. Glad you asked it. We're going to wrap up here, but it's such an important point. So I definitely wanted to touch on that. So Barb, let's wrap it up. Where can people find more about you?
You can find more about me at Barbara Friedberg Personal Finance. See you next time. Bye.
Thanks, Barb. Doug, where can people find more about you?
I had a great question today about college planning, and we actually have a free report you can download and plug into up to 3 schools that you are actually considering. And it'll give you the net cost of it, to affordability, some suggestions of other cost. Email us at info@procollegeplanners.com, and we'd be happy to send you the link to do that free report. And we also have some other information. Check out more information just at procollegeplanners.com. Thanks, Kirk.
Great. Thanks for coming on, Doug. Thanks, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.